Morning.
Good morning. We're back. Another episode of Expandable. And we're getting some love online, which is nice. Everybody's tuning in and getting some value. So I thought what we could do today is jump into, a topic I think that people may not think to ask you, but that's what
Let's
we're
hear
here
it.
for, right? We come up with the questions. How does a bank CEO think about expanding the bank? Because it's a business. Banking
Absolutely.
is a business. I mean, a lot of people may not know that, banks
Yeah,
are
let's
owned
know,
by the
this is
government.
not pre-rehearsed either.
Yeah.
So you're just asking me.
Oh, that's true. Yeah.
Yeah,
You don't
so-
even know. I mean, I told you the question before we hit record.
Correct.
So,
And I know I look at expansion completely different than majority of bank CEOs out there.
Mhm.
I know that because when I go to conferences and meet with other bank CEOs, I always seem to be the odd one out.
yeah.
And
Why is that?
earlier I thought it was just because I was young, but now, now I've been
Yeah.
on and off for 15, 20 years, still the same way.
Yeah.
I wasn't classically groomed through banking organizations. A lot of old time bankers, especially in Florida. If anybody remembers Barnett Bank,
Mhm.
Barnett Bank had phenomenal training. And I think too, going back, they were kind of the gold standard
Mhm.
of everybody still remembers the green lollipops. And,
Yeah. My parents banked there. I was a kid growing up going there.
and I think what Barnett did right, and I never worked for him, and it was a little bit, I remember as a little kid going through there, but I don't, and now hearing people that, still a lot of people are fond memories of their days of working at Barnett Bank.
Yeah.
So, but one thing I remember and learned from that as Barnett Bank grew, and they, one of two things. A bank can either grow organically or they can then buy other banks or merge with other banks.
Right.
Mergers are equal. So that is definitely one way.
You can add deposits and send out loans organically, grow incrementally, or you can do that to a point and then be bought.
Correct.
Okay.
And so for the most part, what people don't realize is a lot of the quote unquote community banks, the smaller banks, they've seen over the years change hands because most of those bank CEOs really go into the attention that we're going to sell the bank in 5 to 10 years at 2 times our equity, 2.5 times our equity. And that's what was going on prior to 2009. And still, I hate that because what happens is when a bank first starts, a lot of times they've got all this capital because they had to have $20 million right off the bat to start a bank. It was required. They didn't really need that $20 million back, but now they're like, oh my God, I got to put this $20 million to work.
Right.
So what they do is a lot of times their margins in the beginning are shrunk. So they I think, grow too fast because they have to have all that capital up front, where it should be more of a tailored approach going in there. Yes, you need to have the ability to have money, and so even when you look at the last couple banks that have started, they've really grown pretty fast. And one in particular, I won't say the name, that in Florida the last few years, I think they're growing irresponsibly.
Okay.
And even their margin, this is one ratio that you never want to be on. So as everybody knows, rates have gone up. Well, so banks are paying more on the deposit. Well, if they've already loaned out money, a lot of those rates are capped. So you have then your short-term rates are going up and you have cap rates. Those loans a lot of times reset, but they may take 2, 3, 4, 5 years to reset to go up to the normal rates. So one of the newer banks already within quarter to quarter, their expense on deposits, if I remember correctly, doubled.
Wow.
It went from 2 to 4%. I mean, that's huge.
Yeah.
So
Cost of doing
what does that
business
mean?
went up, essentially.
So so I don't believe in that. You grow as you're incrementally making money. I think they plan way too much on future favors. We're going to get the business, because what that does is while you're growing so fast in the beginning, just to put on the books so you can break even on that first 20 million. Yeah. I think that's the biggest time you're at risk with economic factors that come into play. I look at growth on different metrics, because you ask the majority of bankers, they just look at asset size. Oh, I want to be $1 billion in assets. If they're 300 million in assets, $1 billion. And for listeners out there, what would be a really small bank is 50 to 100 million in assets. Let's just say 100 million in assets. Yes, would be considered a really small bank.
Okay.
And typically 100 million in assets, you have about, rule of thumb, 10 million in hard equity that,
right.
you put in there. That's the 10 million to lose.
Sure.
And, to educate non-banking area, at what point does a bank get dissolved and is gone? Like Silicon Valley Bank and everything. They have to be imminently insolvent. And that means that, let's say they have equity of 10 million in their 100 million assets. That's a 10 to 1, 10% capital ratio. I won't get in like the details of type of capitals, but good rule of thumb. If you're at 10 to 1, that you're extremely capitalized and safe.
Okay.
It's not even be anywhere like that. They may be a 1 in 50 or 1 in 100. They're just completely leveraged. They don't.
Yeah.
Now, if they just raise funds, they'll have the equity, but different animal.
Right.
You get below 2%, you're gone. Gotcha. So if you're 100 million in assets and your equity drop below 2%, your charter's gone. You're going.
Okay.
And it didn't. We weren't going to talk about it. It's real easy for consumers to look up and pull those ratios because every bank has to publish quarterly into financials.
That's one of the nuggets I think that a business owner a small business owner could take out of this is someone who knows in the future when they're expanding, they're going to need loans. For them to start now building a banking relationship with ideally a CEO, but like, a lender. And as you're talking about these different asset classes, it makes me think, strategically, if you're a very, very small business and you happen to know or you can make contact with a small bank like the 50 million to 100 million, then that's good, but their ability to serve you is going to be not as good because they're not as big a team.
And you have constraints. And typical for us,
as you get
to
bigger,
one person or this, it was a very good metric, one loan or one relationship to somebody's rule of thumb, 25%. So if you've got 10 million in capital,
right,
there's not going to be more than the $2.5 million loan to one individual or one group or one property in relationship. So that's good because
but to your
that
point,
one loan
though,
is putting 25% of your capital at risk. So
correct.
yes,
But to your point, though, from a business owner standpoint, they can look this information up to see where banks are locally or around them. They can make relationships with that are in certain asset classes, and we're kind of giving them the parameters here.
Correct.
And then they could reach out to those banks to form relationships, knowing that as their business grows and they know the projected path, assuming they do, they know that bank is going to be able to help them in a certain way. So they go ahead and start.
And if you look in Silicon Valley Bank, their capital ratios they were growing so fast. Their capital ratios were lower. I mean, I think it was getting 5 and 6% range.
Yeah.
I never ever want to drop below 6%. 6% they consider well capitalized. I want to maintain over 8% because that gives that little buffer too. That on the off chance, because some things you just have economy. There may be a sector you could have wonderful underwriting. It makes no difference.
Right.
You never make a loan thinking it's going to go bad. You think it's always going to pay, but things happen. I mean, are we on a brink of recession? Are we coming out of recession? I don't know. But if, you have apartment, if you have office complexes in northern cities during COVID, you're going to have offices that go under.
Yeah.
I mean, it's a fact. There are going to be some that go under. So, if that sector goes and you drop from an 8% to 7 to 6, at least you're still in the well-capitalized range and you can add back more capital, raise capital, issue more, and, protect yourself.
Yeah.
So protect the bank. So, you asked one question, I went somewhere else. But on growth, I look at it sustainable growth. What can you grow and return on equity? And two, we're a little bit different here. We're a subchapter S bank. And so difference between a subchapter S and a corporation is whatever dollar Surety makes, our shareholders goes to their taxes. So if we don't distribute dividends, they're still paying the tax liability. So if Surety makes $1 million, we don't distribute it to shareholders. The shareholders have to pay taxes on that $1 million.
Right.
So you need to distribute. So we distribute too. our shareholders, and that's what businesses should do anyways.
Yeah, which means that you have to stay close to the community. You have to stay close to your buyers in order to have that distribution be going out.
Yeah.
I mean,
we look at
loans
it,
going out.
So if we make $10 million, distribute $6 million, we have that $4 million, and we'll grow proportionately with that.
Sure.
Now, there's always availability of, do we want to grow faster than that? We've always kind of grown organically from our earnings. And I think that is a strong method because
it's sustainable.
The foundation is there. We're nearly 100 years old. How many have gone away? So that is a good method. If we want to go double and triple in size, then we have to go raise out the capital, and then you have that growth right there. If you've got it locked down, plan, and you're using your same risk metrics, it can be done. It can be done well, but, sometimes I think greed just sets in.
Yeah.
And,
Yeah, sure. Yeah, that has to be kept, in proportion with what you're doing and where you've come from. And I think the balance of sustainable growth is there because what I've seen in the bank too, like looking at your growth over the years, you've stayed close to a certain domain of customers. You know those customers really well individually, but you also know their type, the industry, their businesses, and you're able to serve them well because of it. You see things.
I'll get calls like, I had a referral from a contact on yesterday. I had a few minute conversation and they're, we can bring $300 million in deposits. Maybe if I was 20 years old, I would be excited, but now I'm like,
you've seen that before.
That's okay.
Yeah.
I'm fine. Because I know if one relationship can bring you 200, 300 million in deposits, that one relationship could go away too. Easily, so you want to be dependent on that, So if we brought in, 100 extra million of deposits relation to one relationship, and it could go away. Well, that's the Silicon Valley. What am I going to do with that 100 million? What you do with your deposits, you go loan it out, but that's one relationship to have it.
Yeah. Well,
if you're growing organically through a myriad of different things, it should be broken up. You shouldn't be dependent on that 100 million and then banks now you see, well, hey, we're not dependent on one person. They're all insured because that 100 million is aggregated into, 100,000 consumers that fintech is doing. But you're still dealing with one relationship that could potentially go away. Right. So
I think to translate that to the average business owner watching this, if you have that one big account that comes in, and they're going to pay you 20 million in revenue. Well, you probably want to take it depending on your business model and the upstaffing that you have to do to support it, because you don't want all that to go away. And then,
you need to always be in the position where your biggest customer, client, whatever you call it, you've got to always be in the position to fire them if necessary.
That's right.
Because, and we've had to do that. We've had to eliminate our most profitable customer.
Right.
Because, things happen. Maybe it just.
Well, and also if you're early on and you have that big customer come through, being smart about what you're doing with the revenue. So staying lean. And
you got to know, so that and that's where no good deed goes unpunished. Businesses, you think I'm going to do this one for free, hoping for the future. Yeah. That doesn't work out. No. It doesn't work out. That's just going to put you so much stress. It's going to go through that. And no. So, unless it is beneficial to both at the same time, don't do it. And, always be in it. Okay, great. If we have this customer, largest customer over the next 6 months, did we profit over the 6 months? Yeah. And then it went away. Or were we able to unwind and not impact our capital? Right. Yes, we'll look at it. Because, right now I'm going through a risk assessment on, it's not necessarily a new product. It's just a new way of doing business through agreements and different things.
Sure.
So it adds some level of risk, but I always look at, what if it completely fell apart and nobody wanted into this? Yeah. What is the worst thing that can happen to you? How much will you lose? And, I make sure those things don't impact our capital. So in the new process we're coming out, what's the worst thing if right off the bat didn't work, nobody wanted it, and anything? Well, all my loss was my time ahead to it. But I'd learned a lot going through that process. So really, we didn't lose it. We lost some time. employees' time. They could have been working on something else. You have an opportunity cost, but really, you know, it was a good measure. It wasn't a waste of time, but we're not having to extend millions of dollars. And then what happens? I'm not having to go out there and lock into a whole nother contract for 7 years and pile it upon pile it. And it went away. It's like, oh, great. Income's gone, but now I'm still stuck paying the software contract they don't need that I had for this one customer.
That's right. Yeah. And if you had to staff up, whether it's 2 people or 20 people to take on that new business, well, you're going to have to let those people go. Right?
Correct.
So that's a stress. And
you don't want to do that, but at least in that position, because you know, always see like, I always wonder growing up, oh, gee, he laid off 10,000 people. You know, to them, they're at such a large scale, you know, they have so many different divisions, so many different products. So they're leading one division, and over time, what worked 50 years ago may not work now.
Yes.
And so, okay, they had to go. And
so
you want to put in, but one employee for a community, you know, a job's a job, regardless of 1 or 10,000. So you got to take that in consideration.
Yeah. Well, the other thing that came to mind too, watching you grow the bank is, you know, and we talked about a little bit here, is just the proximity that you are to your customers. You're always staying very attuned to what they need and building products and services around their needs. And, you know, I think that translates to every business. The more, I think businesses, from my perspective, is they don't stay in front of their customer enough in order to know the truth of what's they're thinking and how they're moving and shifting and changing their needs and solutions that are needed to solve those things. But I've seen you do that. And what's cool is it allows you to grow organically, naturally, incrementally over time and stay sustainable, because those customers, the retention rate's super high.
We've got great retention rate. And right now I'm seeing where we're adding a lot of treasury services. So those are the things over the layout that we're adding on to not only enhance our existing customers, it'll make their life more efficient too.
That's right. Yeah. So I think that's something for business owners to take, you know, and think on, how close are you to the customer? Or do you really know what they need, or do you really know what's changing in their world? Yeah. Or are you just kind of living in your world, going through the motions? And
don't assume you are. And I've made the mistakes over the years, assuming what you need, or talk to them and
that goes to the salesperson point. You know, people try to sell you things, and you think, oh, well, maybe I need this in order to.
No, I mean, what was it? Years ago, and salespeople were like, oh, we'd be able to sell the accounts if we had this credit protection we added on to, and we had this. Okay, get the credit protection, add on if you don't. Then when I found out, like over time, when people open up a business account and the new accounts reps going through all of this, the new accounts person fixated on these little add-ons, and you know what? They didn't really care. No. When people now think of credit protection, they don't think of it for a bank. They don't think of this. And then it took away from like your heart of it. And so that's what happened to me. It wasn't that we needed that to sell. It was because that salesperson, they thought they needed it. They were wrong.
Yeah. They got distracted.
Correct. They truly did.
Yeah. Well, that's good. I mean, that's a really good insight into your mind about how you're operating the bank and in light of growth. You know, so I think that's all valuable for business owners to think and translate.
You know, we're going to be here tomorrow. And then what it taught me, you know, going through the Great Recession, and when you're in a position, you have a lot of foreclosures because of economic reasons. I mean, it got where it was socially acceptable to people say, I had a short sale. Yeah. I mean, that was going through even
it's true.
Everybody in congregations at churches, it was acceptable. Yeah. And still you're thinking, you accepted that money, right? Even though you have available to pay just because your asset decreased, you don't want to pay. And you think you've rationalized in your mind that that's ethical. You just took $400,000. Oh, I'm going to short sell it $200,000 because the equity's not there. And they were perfectly comfortable with that. And that is carried on, and that passed on to their children. So don't forget, that's still, the generation is there. It's perfectly acceptable for a short sale. Right. I don't know about you. To me, that is not acceptable. If you can afford the payment, if you got put in that position, that's fine. Or, you had unscrupulous salespeople that put you in a product that had no ethics just because you could, technically get approved for it. That's a different circumstances. But you made the decision to buy that house and to go through there, and then it turned the other way, and now you're just, let the bank have it.
Yeah, I mean,
are you kidding me?
You're 100% correct. I mean, you made the commitment. So what is that worth? Yeah. We can kind of get into a moral question of it, but But yeah, I agree. I think you're not thinking of your commitment to the lender, or you're not thinking about what is actually right in this scenario.